Hello friends, once again I welcome you all to my YouTube channel. And before starting the discussion, let me thank you all for your interest in the subject, your suggestions and your feedback. I got a message from few of our friends to upload a discussion on export finance, and honestly speaking this subject is highly important for the exporters. Let me take an example. If you are an exporter and you got very good order from an importer sitting somewhere in USA, probably your first time customer, okay, and you see a very good margin in this order, you are confident of getting more orders in the future based on this transaction, but you don't have sufficient working capital to arrange the raw materials, to meet the production expenses, warehouse expenses, etc. In this situation, what will be your next step? Arranging the working capital, right? So now what are the best possible sources for obtaining the working capital or getting the working capital financed? Apparently the government banks, isn't it? But you should also know what all credits can be taken for such requirements. What are the facilities offered by the government of India to meet such requirement of working capital for export business? What is the credit period? What could be the maximum amount of finance? Can it be obtained in Indian rupees and foreign currency as well, or just in Indian rupees? At which stage of export process, at which stage of shipment finance can be obtained? What are the prerequisites to get such loans? Who all are eligible for getting this kind of export finance? There could be many more questions in the mind of an exporter, and today I am trying to cover maximum information that an exporter might need. Basically, I am trying to divide this entire session in three or four. I'll try to cover this entire topic in three different sessions. Okay, and second and third session will be uploaded very soon, probably within a week or 10 days. So let's start the discussion on export finance. Okay, so it goes like this. First of all, what is export finance? Okay, so in a simpler way, in a very simple way, I can tell you it's a financial assistance extended by the banks and other financial institutions to businesses for the shipping of products outside a country or region. And it is very helpful for medium scale industries or small scale industries because it helps them in reaching to their customers outside the country. Okay, so the next question is, who can finance? So who are the institutions who are authorized to arrange this kind of finance? So short or medium term finance can be arranged by Indian and foreign commercial banks. Generally, Export Bank of India or Exim Bank arranges the medium term, and RBI is the institution which refinances these banks. Okay, and rate of interest for this export finance is concessional. It's a lower rate of interest than normal rate of interest. Okay, and these banks, as I told you, these banks are refinanced by RBI and Export Import Bank of India. Financing banks entitled for an interest rate subsidy. So the rate at which RBI provide loan or refinances these banks is a concessional rate of interest. So they get some kind of subsidy on the interest rate. But there are certain kind of risks like political risk or commercial risk associated with export business, and this risk is covered by Export Credit and Guarantee Corporation, ECGC. Okay, so moving forward, what are different types of export finance? First is pre-shipment finance. Second one is post-shipment finance. So there are some loans or some advances which are granted by the financial institutions to exporters for financing the purchase, processing, manufacturing, or packing of goods before the shipment. These all finances come under pre-shipment finance. But there are some loan or some advances which are granted by financial institutions to exporters from the date of extending credit after shipment of goods to the date of realization of export proceeds, and this is known as post shipment finance. Okay, so now we will see what are different kinds of pre-shipment finance. One is packing credit, another is advance against incentives, third one is PCFC, that is pre-shipment credit in foreign currency, and I'm trying to cover one more type, that is advance against checks or drafts. So there are four different kind of pre-shipment finances primarily. Pre-shipment finance is a secured loan, means you need to pledge certain kind of security for getting this kind of finance from the bank, or there is a possibility that this finance would be clean at the beginning and later on it will be converted into hypothecation. So coming to the packing credit, why do we need packing credit? So for procurement of raw materials, because when you go to market or when you go to different agencies for purchasing raw materials, you need to pay some amount to them. So this packing credit helps you in getting finance or capital amount for purchasing raw materials. Then to carry out the manufacturing process, because raw material need a kind of process to getting it converted into the finished goods, and this manufacturing process involves some expenses, some capital amount is required, some working capital is needed. So the packing credit provides this kind of expenses, right? Then to meet the cost of warehouse for the finished goods and raw materials, because you cannot store it free of cost. Even if it's your own warehouse, it requires some kind of cost. Or had you not used your own warehouse for storing your raw materials or finished goods, you would have earned some income for storing others products in your warehouse. So simply warehousing requires some kind of expenses. So packing credit helps you in meeting that kind of expenses also. And the last one is, in fact not the last one, next one is the processing and packing the goods. So processing and packing the goods require some kind of expenses. So packing credit helps you in meeting that expenses. And finally, shipment of goods to the buyers, and there could be some other financial cost which is required. So packing credit helps you in meeting this kind of expenses. Now the next question is, who can get the packing credit? And the simple answer is all exporters. And what do I mean by all exporters? All exporter means manufacturer of goods supplying to export trading or star trading or superstar trading houses and merchant exporters. Okay, the merchant exporter themselves, export institutions, or export I can tell you the companies involved in export, star trading houses, superstar trading houses, manufacturer exporter, merchant exporter. I mean all kind of exporters are eligible for getting the packing credit, including the manufacturer of goods supplying to export trading or star trading or superstar trading houses. Okay, and the next one is, what are the criteria for getting packing credit? So these are the criteria, and this slide is very important. I request all of you to make a note of it. The exporter must have IEC number. Let me assume that you still remember what is IEC number. IEC number is a 10-digit importer exporter code given by DGFT. And the next point is, exporter should not appear in the caution list of RBI. Then license or quota permit if the goods to be exported are not under OGL. What is OGL? OGL is nothing but open general license. I'll try to write it down. Let me try. Uh, don't worry about this handwriting. It's pathetic, I know. Just to help you out so that you can make a note of it. It's open general license. Okay, that is OGL. Fine. Then packing credit facility can be provided to an exporter on production of the following evidences to the bank. First one is the formal application for releasing the packing credit with an undertaking to the effect that the exporter would ship the goods within a stipulated due date. You need to ship the goods, you need to dispatch the goods within the stipulated time and submit the relevant shipping documents to the banks within prescribed time limit as a proof of shipment. Okay. Then the next evidence is firm order or irrevocable letter of credit, also given under the rate clause letter of credit. Okay, so even if you have a rate clause LC, you can go for packing credit. In this case, what happens? Repayment is the responsibility of the foreign bank establishing the LC. So the bank which is issuing the LC, they themselves are responsible for the repayment. And license issued by DGFT if the goods to be exported fall under the restricted or canalized category. So there are some goods which are restricted for export, and if the goods which you are planning to export fall under such category, then you must have a license issued by the DGFT. Then if the item falls under quota system, because the government imposes some kind of quota system to ensure that the goods cannot be exported outside the country within beyond a certain quantity, beyond a certain limit of quantity. Okay, so if the goods which you are planning to export fall under such quota system, proper quota allotment proof needs to be submitted. Then there is a term running account facility. What is this running account facility? So running account facility is basically a scheme under which packing credit advances can be availed even without having confirmed order or LC. But there are certain conditions which need to be fulfilled. Okay. I'm just putting it in a simpler way. Sometimes if you are an exporter and you are not able to produce the export order or LC at the time of availing packing credit, the bank will give you packing credit. Okay, and that comes under this running account packing credit facility. Okay, but there are certain conditions, and let's have a look at those conditions. Establishment of the need for running account facility by the exporters to the satisfaction of the bank. So the bank will prefer to have LC or certain kind of proof of firm export order. If you are not able to produce those documents, those evidences, okay, you need to establish the need for running account facility, and the banks must be satisfied with your explanation. Then you should have a good track record. Then LC or firm order is produced within a reasonable period of time. Even though the loan was given without producing LC or firm order, you need to produce LC or firm order within a reasonable period of time. And for commodities under selective credit control, banks insist on production of LCs or firm orders within 1 month from the date of sanction. And the concessive credit period, this packing credit period, should not be more than 180 days. Okay, so moving to the next slide. Here I have listed some general questions, some questions which might come in your mind or which might come in the mind of an exporter, and I have listed out these questions. So let's have a look at these questions. what is the amount of packing credit finance? How much amount can be financed as this packing credit? Answer is very simple. There is no fixed formula. There is no fixed formula which will decide the amount of packing credit finance, but basically the intention is this amount should be adequate enough for the exporter to execute the order. And generally, how much is the adequate? Okay, and generally this is sanctioned to the extent of domestic cost of production or FOB value of export order, whichever is lower. In some case, what happens, your domestic cost of production is higher than the FOB value. Okay, in that case, what happens and how is it possible? Does it mean that you produce something by incurring a production cost of $200 and you are selling this goods to the importer at 180 or 185 or $150? It means your business will be in loss. But here in this case, it's not like that. I'll just read it out. It can be to the extent of domestic value of the goods, even though such value is higher than their FOB value, provided the goods are entitled to duty drawback and also covered by the export production finance guarantee of the ECGC. So the duty drawback, when you get this duty drawback from the government, you might have paid this excise duty or some other duties in the beginning, and the government will pay you back this duty. So ultimately your cost of production will come down and your export business will be in profit, unless and until you intentionally lower down the FOB value. Okay. Then the next question is, what is the period of packing credit finance? So initially it should be maximum for 180 days. And can it be extended if needed? Yes, this period can be extended for a further period of 90 days in case you are not able to ship the goods within 180 days due to some circumstances which are not under our control. Okay, if I am an exporter and for some or other reason I am not able to ship the goods within 180 days of this packing credit finance, then I will apply for an extension period, and the bank has got right. The commercial banks have been empowered by the RBI to extend this period for another 90 days. So totally it could be of 180 plus 90, that is 270 days. But it is subject to production of there is also a case where packing credit finance period can be extended subject to production of revalidated export order or letter of credit by the exporter. Okay, and RBI has empowered the commercial banks to extend this period of 90 days. For every extension, the bank need not take permission of RBI. Then the next question is, what is the interest rate under packing credit finance to exporters? Okay, because it's important because we cannot go for something which is not feasible. If the interest rate is too high, that will make our export business incompetitive. So the banks have to charge concessional rate of interest on the packing credit to make the export products globally competitive. If you get this finance at a lower rate of interest, your cost of production or your cost of your COGS of goods will be lower. You will be in a position to offer a very competitive rate to the importers. Okay, and for that reason the banks generally provide this packing credit finance at a concessional rate of interest. As per the directives of RBI, Reserve Bank of India, the rate of interest charged on packing credit has to bear a relationship with the prime lending rate. And what is that relationship? I don't think I have mentioned that relationship here. Okay, but I'll just explain to you. You can make a note of it. If you are going for pre-shipment credit in local currency, the relationship between PLR, that is prime lending rate, and the rate of interest is PLR minus 250 BP. What is this BP? BP is nothing but basis point. And what is basis point? Basis point is equivalent to 0.01%. Okay. So each bank fixes its own prime lending rate. Banks are given the freedom to charge the rate of interest to make the interest rate competitive. An interest rate for the first 90 days will be cheaper. The next 90 days will be on a higher side. And if you are going for extension of this packing credit finance period, the last 90 days, the extended period of 90 days, the interest rate for the extended period of 90 days will be even higher. However, the interest rate of the bank has to be lower than the PLR of that bank. And banks are not allowed to charge any other service charge than those stipulated by FEDI, Foreign Exchange Dealers Association of India. So FEDI, they have already stipulated some service charges. So banks cannot charge any other service charge or any other charge other than those service charges mentioned by the FEDI. And the premium payable to ECGC has to be borne by the exporter. Bank will not bear the premium payable to ECGC. Next question is packing credit limit guided by the other loans given by the bank? What does it mean? Suppose you are an exporter and you have taken some other loans from a bank. Does it have any effect, any impact on the credit limit, packing credit limit? Answer is no. The packing credit is a separate finance given to exporters and is not connected with any limit of other loans given by the bank. Packing credit loan account is opened separately if needed. This loan account is closed by adjusting against the export proceeds of the said export order. So if you are taking packing credit finance against a particular export order, the export proceeds, the amount paid by the importer against that export order will adjust the packing credit. Okay. The next question is pre-shipment finance available for consulting services? I mean, an exporter need not be the exporter of goods only. There are many exporters, there are many firms which export services. So are those firms also eligible for getting pre-shipment finance? Yes. In case of consultancy services, exports do not involve physical movement of goods out of Indian customs territory. In such cases, pre-shipment finance can be provided by the bank to allow the exporter to mobilize resources like technical personnel and training them, because that involves cost, that requires some kind of expenditure, right? And is it necessary to have a new credit account every time for getting pre-shipment finance? Because here I have mentioned that the packing credit finance is a separate finance given to exporters and is not connected with any limit of other loans given by the bank. At the same time, packing credit loan account is opened separately. But if I am an exporter and if I export 10 times in a year, does it mean that I need to go for 10 different accounts or a different account each time I am exporting to other countries for this packing credit, for getting this packing credit? Answer is no. We can have a rolling settlement account also, and that avoids the painful process, the cumbersome process of opening a new account every time. You need not open, the bank need not open a new account every time for every such transaction. Okay, you have a rolling settlement account. So you take a packing credit, you get the export proceeds, adjust it against the packing credit in the same account. You can go for the next packing credit whenever you require. Right? Moving forward, What happens if the export order get cancelled or not executed after taking PCFC, that is pre-shipment credit in foreign currencies from the bank? In case of cancellation of export order, or if the exporter is unable to execute the export order, it will be in order for the exporter to repay the loan together with accrued interest thereon. So for that period of time when you have cancelled the order, and when you have decided, or when you know that this order cannot be executed, even you have taken PCFC. I have not explained about PCFC, but basically PCFC is nothing but a packing credit you take in foreign currencies, right? It's a pre-shipment credit in foreign currency. Okay. So when you take this pre-shipment credit in foreign currency, and for some or other reason this order cannot be executed or get cancelled, then you need to repay this amount along with the interest amount in foreign currencies. You can purchase foreign exchange from domestic market through the bank, and you can repay the amount in foreign currencies along with the interest amount, right? It will also be in order for the bank to remit the amount to the overseas bank, because sometimes what happens, the bank purchases these foreign currencies from overseas bank, and when you repay this amount to the domestic bank, or to your financing bank, that bank remit this amount to the overseas bank. Okay, provided the PCFC was made available to exporter from line of credit obtained from that bank. In that case, this domestic bank will remit the amount to the overseas bank. So that was all about packing credit. The next one is advance against incentives. There could be a condition when procurement cost is more than the FOB value of the contract. That's what we discussed few minutes back. Okay, let me explain it once again. How is it possible? It is possible when the export is covered under the scheme of incentives by the government of exporter country, like duty drawback. Exporters may get packing credit advance more than the FOB value of the goods. And how about the difference? The difference between the excess of cost of production and the FOB value of the contract is nothing but the incentives. We already discussed about it. So let's move forward. And the finance is covered by the Export Production Finance Guarantee of Export Credit Guarantee Corporation, that is ECGC. That takes care of the risk associated with this transaction. And in this case, advance can be given to the full extent of cost of production. So we covered two different types of pre-shipment finance. One is packing credit and another is advance against incentives. The next one is pre-shipment credit in foreign currency, that will continue in next discussion. And let me thank you all for watching this video. You can contact me on my email ID, that is kumarwinsag@gmail.com. And if it's really very urgent, if you feel that you need to communicate to me urgently, or if there is something good to be discussed on WhatsApp, here is my mobile number. It's 901415022, and you can contact me on this by WhatsApp. Okay, so thanks a lot, and very soon I'll come back to you with the next discussion, that is PCFC, and there is one more, last one, right, against advance against checks or draft. So see you soon. Till then, keep watching. Bye bye.